This week on Case Studies with the Biz Doc, it's Rent the Runway, the fantastic company that allows you to rent high-end clothing for a big event and then return it later or even buy it. We've got the full story from the founding at Harvard to the venture funding to an upcoming IPO of over $1 billion this week. Rent the Runway, an exciting company that allows you to rent clothing, high-end dresses, ski apparel, other types of clothing for an event and then return them or even buy it. You've got... Hang on a second. What are you doing here? You want... Oh, okay. She wants to say something.
Hi, Brooker here again. As you know, Biz Doc is my dad. And before he does the case study on Rent the Runway, I have two things to tell you. One, more VCs should support women founders like Jennifer and Jennifer at Rent the Runway. Two, let the IPO play out. Many businesses were down due to COVID. Everyone chill out and let's see where it goes. Okay, back to the Biz Doc.
Let's take a look from the beginning and let's see who founded it and what were their influences. Rent the Runway was founded when these two women at Harvard were talking about concepts, Jennifer Fleiss and Jennifer Hyman. And they were at Harvard taking classes together and talking about fashion, rental fashion, and a variety of things that were in the zone when they decided to connect with Diane von Furstenberg. So in the bright idea bubble here, we have Diane von Furstenberg, who they came to and said, hey, maybe we should do something with you, with your brand. Diane said, no, why don't you do multiple brands, multiple designers, and make it your company, not an extension or a feature of my company. They took that advice, and Jennifer were off and running. In 2009, in July, they had about $1.6 million of seed capital. Now, they're at Harvard with a lot of great contacts and connections. They're really thinking out their business concept, and they're working with Diane von Furstenberg, so they've got access to people, and part of those were at Bain Capital Ventures. And at Bain Capital Ventures, 1.6 million seed came in. So that's a pretty healthy seed, but you're talking about Bain. So Bain had a vision to support these female entrepreneurs who were off and running with rental fashion. They would then raise a Series A, so they had some traction and things went well. There was articles in the New York Times. There was a lot of very good buzz about the concept. And in February of 2010, they raised $15 million from Highland Capital. Then 1 year later, June of 2011, they raised Series B, $15 million from Kleiner Perkins. So they're doing a good job getting money from all across the United States from Tier 1 venture and funding partners. Then it would be 2 years. In 2013, they raised a Series C, again led by Kleiner, for $24.4 million. These are just the lead investors. There were other investors involved too, such as American Express, T. Rowe Price, TCV, Fidelity, and Franklin Templeton. So there was a host of other investors that were joining these, and these were the leads, as I understand it, and the research showed. And then in 2015, there was an executive shift, and there was some press about people leaving. Now, I don't necessarily think this is a bad thing, because sometimes people that come from corporate jobs into a startup with the pressure, the iteration, the speed, and limited resources, raising money all the time, worried about your burn rate, sometimes that is not a good cultural fit long-term for corporate executives. They think it's a hot job at a startup, but there's a culture and there's a dynamic that requires you to work. It's just different. It's not good or bad. It's different. And either you and your career are suited to that or you're not. There's a lot of personality in it too. So when I see executive shifts, I'm not really concerned, especially when you get financing keeps following the company's development, such as about the time we've got all this press about executive shifts, a Series D, Highland Capital. Then a year later, in December of 2016, a Series E with Fidelity leading. And we add retail stores to the mix and we add subscriptions. So there's things happening with the business, moving it forward and developing this business model in the midst of the executive shift. And then Jennifer Fleiss, the co-founder, decides she's going to leave and go to Jet Black. And Paul, I believe that's a concierge service for shopping, is it not?
Yes, sir, Tom, it is.
So she stays in fashion and shopping with the concierge service she goes to, leaving Jennifer Hyman to continue driving the company. And drive it she did. In 2018, this is very interesting. I have this circled here because the series F and G, I'm interpreting those as a series F and G from my research, but they weren't labeled that per se. But nonetheless, $20 million comes in at an $800 million valuation from Jack Ma. Yes, the Jack Ma from Alibaba. He is joining all of these wonderful venture capitalists and private equity and banking supporters of the female entrepreneurs and of Rent the Runway. Then, August of 2018, we have a debt offering, $200 million from Temasek. So they're still continuing to burn money, but they also have ample money to go raise. And by the way, if you think this is big, go take a look at Uber and Lyft, what they were burning. They would burn that in a weekend. We then go to 2019. I interpret as a Series G. It's a $1 billion valuation. $125 million from Bain. And whether the billion was there or at the beginning of I can't find the specific announcement of it, but there was a little bit of a down round as during the COVID time and a $50 million small round or potentially a bridge. I saw some articles that talked about both. But nonetheless, during COVID, there's a little diminution of value, but they're still very close to this billion-dollar unicorn status. And by the way, where I come from in venture, that's not a down round. $200 million in a full recap valuation, that's a down round. And that would be one of those dams. But this still is a company finding its way, driving forward and adding subscription and getting some traction at the time that COVID happened. And COVID impacted so many businesses across the globe. So now let's take a look. They're headed for an IPO, and they have a $1 billion valuation. There's an IPO out there, but hang on. When you go and read about the IPO, Goldman is leading it with Morgan and Barclays in tow. My goodness, 700 designers. They're the largest dry cleaner in the world, apparently, in two big distribution cities, New Jersey and Texas. There's only one word for that, is damn. That is a big fashion company with big support with some big banks. Looking at a $1.3 to $1.4 billion valued IPO based on the analysis that I saw, that I did, and I also saw other analysts that kind of read it the same way as we go through the IPO documentation. So now let's go take a look at what's underneath this. So during the COVID crisis, they had to lay off a ton of people, and they also closed their stores, but they learned something about those retail stores. People were using them in the big cities to come drop off what they had rented. So they were like, hey, we don't really need retail stores, but we do need drop-off locations so we could get something that someone rented to our dry cleaning facility, get it all perfectly cleaned and back into inventory for the next person to rent it. The headlines say, Rent the Runway to close their stores. I looked at the fine print and I said, no, they just learned something, that you don't necessarily need a store. The customer is using the store to drop off. You need more drop-off locations. So customers were teaching you what you needed in your company. So go do it. And do it they did. So now let's take a look at what was in the IPO document, the S1, so that we can kind of analyze things. So first thing on subscriptions. Subscription is recurring revenue, ARR, annual recurring revenue or monthly recurring revenue, MRR. The difference being, what is the customer paying for? Is it a monthly contract that you pay month to month until you cancel? Or is it an annual contract like you have for a cell phone? It's a 2-year contract because you bought the phone for less money than it would cost, and you're in a 2-year contract until the phone's paid for as part of your monthly bill. So that's ARR. So they start a subscription business here, and in 2019, total subscriptions were 147. That would drop to 95 in 2020. Well, that makes sense. A lot of events were not happening. I went to a wedding that was delayed twice. It's not a surprise to see the total subscriptions drop, but they rebounded through June 30th of this year, and right now we're in the fourth quarter of 2021 with the IPO just recently been announced, and for 6 months they say, hey, we have got 30,000 subscriptions back 126. This is their total. Now here's something I really like that they do. They present active subscriptions and total subscriptions, and inside the documentation they describe the difference. But I like that. So they said there was 133 of the 147 in 2019 were active, and then only 54 were active out of 95 in 2020, the COVID slide. Now 97,000 are active out of the 126. Well, take a look. They popped back 30,000 more total subscribers, but they got 43,000 more active subscribers. Well, now let's look at the revenue. And the revenue is, this is where the company really needs to show Wall Street and show the investor community that they can build a profitable business. Revenue was $256 million in 19 with a loss of 153. So that's kind of a heavy loss on that, but they built a company that's $250 million in revenue. So you figure, is there something in here where they can kind of figure this out? Where can we get costs? Should we own the largest dry cleaner in the world, or should these be outsourced? A lot of questions will happen to that in part of the normal evolution of thought as you try to build profitability into the business model. So nonetheless, in 2020, only 157 million, remember the COVID year, and 171 loss. Well, that makes sense because you lower the revenue, the loss is going to accelerate and be bigger than the previous year loss when revenue is highly truncated. Now, 6 months this year, it's $80 million on 87. Now, this is where I hope the second half of this year is stronger, and I'll tell you why. Because 80 times 80 for full year would be 160. 87, this is back, about 170. So 174. So the first 6 months is tracking the performance of 2020. Remember, the first 6 months of this year, there's still a lot of COVID stuff coming on. COVID Delta variant, a lot of bad news around that. So the hope is that the second 6 months here are going to show how they're using subscription to drive forward and to make the business run. Now, in addition to drop-off locations, they started here in 2021 a buy option that you could buy secondhand from them without a membership. So you didn't have to get a membership, didn't have to be a subscription, but you could come online and buy something secondhand. You've been able to rent to buy since 2016 with their subscriptions, already had rent to buy. This is people without a subscription, just coming in secondhand to buy one or two things without a membership. So it's kind of, I think, of a little bit of a competitive reaction to Poshmark, but I happen to think Rent the Runway is better positioned. What are some lessons for you and me? This is a company that started with a conversation with Diane von Furstenberg and some very high-end investors that we normally wouldn't have access to. But what are some learnings that we can absolutely apply, even if we're not on a 13-year run here trying to find profitability? The first is focus. They always focused on fashion, and they focused on process, and they focused on efficiency, and so they kept their focus. They didn't decide to be a clothing maker. They didn't decide to be a contract manufacturer. They stuck with, we believe that there's an audience out there that wants to rent not only dresses, other apparel. You can rent ski apparel, which is very expensive, and then buy it or just rent it for the trip. So focus, they kept their focus. And next is, they found friends in high places. However you find friends, build your circle of friends. You may not have friends with names like Bain, Highland, Kleiner, TCV, Fidelity, T. Rowe. You may not have immediate access to them, but wherever you have access to your friends, build your circle of friends. Always ask them for referrals to people that might be able to help you, whether it's business or it's investment. So they had a great benefit from friends, but you and I can do that. Maybe not at the $15, $24, and $60 million level. Maybe it's something smaller, but you can always build your circle of friends. And it always is kind of surprising to me how many entrepreneurs are just head down and they're not really building the circle of people that could help them when it comes time to investment. They just want to get out to the one great big investor that could give them a $10 million check. Nope, build a circle of friends, no matter how big or how small your particular neighborhood in life may be. And lastly, survive. You already heard what I think about the executive shift, and then the two founders went their separate ways to do other things, although Fleiss stayed on the board, and she's still apparently active as a board member, and obviously she's got significant ownership, so she's interested in the success of Rent the Runway. So the financials, I'd love to see them be stronger. I'd love to see them show it, and subscriptions is a path to get there, but they have to prove that they can scale it forward. But until then, yes, indeed, this just in the time since I filmed this case study, we were getting ready to edit it and the IPO went out. I'm going to share with you what has happened because it's highly relevant here and some of the news stories with it are lining up with the analysis in this case study. First of all, I had predicted the IPO would go out at 1.3 to 1.4 billion in market cap, and indeed it did. They priced at $21, right about in this range. And what happened, it went up to $24 on the first day of trading, but then dropped down at the end of the day. Now, here's what happened. The IPO goes out, there's some demand, people are buying it, and then there's a sell-off. The sell-off may be some of these investors sold some of their shares on the first day of the IPO. More people selling than buying creates downward pressure, and the price went down to $19, which is below the IPO. So the IPO in the morning at 21, it settled at 19. So at the end of 2 days of trading here, we are at 1.1 billion, lower than the low end of my estimate, and they raised $357 million. That's the proceeds to the company as a result of the IPO. Now, if you take a look here, losing 171, 153, with whatever they have in the bank from this last 125 and the 50 that was here 19 and 20, whatever they've got in the bank, plus the 357, they have to find this path forward to profitability. And as I shared, subscriptions are the path. And there's a lot of good things that were happening there. But I wanted to add this through the miracle of insertion editing to give you an update on the IPO itself, to go at the end of the case study to really round this out and make it complete with the full story for you. So there they are, below the range. So the market is feeling, hey, you got to show me. That's what the market is saying here is, hang on a second, you need to show me what you've got. And that 1.1 billion is sitting right here, even with their last financings over the last 18 months. So the market is saying, we don't really think you're more valuable than you were here. You need to show us. But again, we've had COVID, we've had a lot of things happening. So I think, to sum it up, they need to take what they've done here, all the great underpinnings they've got, the dry cleaning facility, the 2 big distribution centers, and I think they call those dream centers or future dream centers or something, where the future dreams are stored. They have automated racks that put the dresses and clothing in there so they can get them out. So they got a lot of great infrastructure here, but they do need to show us that they can generate the subscriptions and turn these losses into net income, EBITDA and net income, to drive to the future. But they do have a war chest now of about 357 million plus whatever to get there. Okay, so all said, there you have it. We're going to see through transparency of the quarterly report how they're doing. And right now, somewhat below the range I had estimated, but in line pretty much. And it's up to them to drive those subscriptions, as I've discussed, and show us that they can make it in the future where Rent the Runway becomes a successful, profitable, long-term story. Well, that's what I think about Rent the Runway, but what do you think? Leave me a comment down below. I answer as many as I can. And while you're there, please subscribe to Valuetainment, the best channel on the internet for entrepreneurial content. And if you like this case study, here's one from the Biz Doc archive that I think you'll like just as much. Until next time, I'm Tom ELLSWORTH, the Biz Doc, and I hope I left you better than I found you.